Before we even think about investing, we need to talk about the single most important rule for any new investor: diversification. It sounds like a complicated word, but it is a simple idea you already use. You don't put all your eggs in one basket, because if you trip, you have lost everything. But if you have 5 baskets, that one little spill isn't a catastrophe. That one idea is the core of our entire plan. We're going to spread your $1,000 across different types of investments. This way, if one part of the market is having a bad month, another part can be doing well, which smooths out the journey and seriously lowers your risk. This is the secret to staying confident and building a strong financial base from your very first dollar. All right, let's get into it. Our very first move, and honestly, this is the most important one, has nothing to do with chasing big returns. It is about building a rock-solid foundation. We are taking $100 of your $1,000 and putting it directly into a high-yield savings account, or HYSA. Now, I know what you're thinking. That sounds boring, right? But this isn't just an investment. It is an investment in your own confidence. This $100 is your peace of mind fund. It's totally liquid, which means you can access it immediately without any penalties. This money is basically zero risk and is FDIC insured. And an HYSA is not your parents' dusty old savings account. It pays so much more in interest. While a traditional savings account might give you next to nothing in interest, a good HYSA can offer over 4% annual percentage yield, or APY, in today's market. A normal or traditional bank only gives you maybe 0.01 to 0.05 APY. If you invest $100 for 1 year at 4% APY in an HYSA, and the interest is compounded monthly, you would earn about $4.07 in interest, but only about 4 cents at a 0.04 APY in a traditional savings account. You can open an HYSA account with these online banks like Ally, SoFi, Marcus, or Discover. Why is this the non-negotiable first step, you ask? Because life is unpredictable. A sudden car repair, a surprise bill. Without this cash, you might have to sell your other investment at the worst possible moment. This $100 is the anchor that keeps your entire plan stable while the rest of your money gets to work. Okay, peace of mind fund is set. Now it is the time to start thinking about the long game, like decades. Let's take the next $300 and put it into a Roth IRA account. Let me be clear, a Roth IRA is not an investment itself. It is more like a special container that gives your money a superpower: 100% tax-free growth. I'm going to say this again because it is critical. Tax-free growth. You contribute money you have already paid taxes on, and in exchange, your investment can grow for decades. The catch is that this account is designed for retirement, meaning you generally cannot touch the earnings until you are 59 and a half without paying taxes and penalties. But when you do retire, you can take out every single dollar, your original money, and all of the earnings completely tax-free. For a new investor, this is one of the most powerful wealth building tools that exists. So what's the move? You open a Roth IRA with a low-cost brokerage like Fidelity, Vanguard, or Schwab. Deposit your $300, and then you just need to invest inside of that account. A brilliant set-it-and-forget-it choice for a beginner is a broad market index fund, or ETF, that tracks the S&P 500. The S&P 500 is a stock market index that tracks the performance of 500 largest, most successful companies in the US, like Apple, Amazon, and Microsoft. It's often used as a benchmark for how the overall US stock market is doing. For 2025, the contribution limit for the Roth IRA is $7,000, so this $300 is your first step. By doing this now, you're planting a seed that has the potential to grow into a forest of financial security. We've got our safety cash and our retirement engine. Now let's build the core of your portfolio with money you can actually access before you retire. We're taking another $300 and investing in exchange-traded funds, or ETFs. but this time it's inside a standard taxable brokerage account. You might be thinking, wait, didn't we just do that in the Roth IRA? And yeah, you're right, but the account itself is different. The Roth IRA is for retirement. This account is for your medium-term goals like a down payments for a house in 5 to 10 years, starting a business, or just building wealth that you can use sooner. An ETF is just a basket that holds small pieces of hundreds or even thousands of different stocks. So instead of stressing about which single company to bet on, one purchase lets you own a tiny slice of the entire market. For example, buying an S&P 500 ETF makes you a part owner of 500 of the largest companies in the US. It is the most simplest, most effective path to instant diversification. Examples of good ETFs to look into are 1. VOO, which tracks the S&P 500, includes 500 top US companies. 2. VTI, which covers the entire US stock market. Or 3. VXUS, which tracks over 7,000 companies from outside the US in developed and emerging markets. ETFs trades just like stocks. They have incredibly low fees. And here's the best part. You can buy fractional shares. So if one share costs more than $300, it is no big deal. You can just buy a piece of it. This $300 is the workhorse of your portfolio, designed for pure, simple growth. We are more than halfway through, and you have already designed a smarter portfolio than most people ever will. If you are starting to feel that anxiety turn into excitement, do me a quick favor and hit that like button. It tells me that this is valuable and helps the channel a ton. Thank you so much. So far, our plan is pretty heavy on stocks through our ETFs. Stocks are fantastic for growth, but they can feel like a roller coaster. To smooth out the ride, we need an anchor. That's our fourth move. We are taking $150 and investing in bonds. Think of a bond as an IOU. You are lending money to a government or a big corporation, and in return, they promise to pay you back with interest. Bonds are the chill, predictable friend in your portfolio. When the stock market is acting crazy, bonds tend to be much more stable, and sometimes they even go up when stocks are down. It is the balance that makes them so powerful. For a beginner, the easiest way to do this is, you guessed it, a bond ETF. Instead of getting lost in the world of individual bonds, a total bond market ETF gives you a piece of thousands of different government and corporate bonds in one click. This $150 isn't here to make you a millionaire overnight. Its job is to be the calm in the storm, lowering your portfolio's overall risk so you can sleep at night. You can buy bonds through your brokerage firm of choice. I invested in BND, which is a giant basket of US bonds. Our portfolios looks amazing. We have cash for safety, stocks for growth, and bonds for stability. Our final move, let's add something with a different flavor, something outside of traditional stocks and bonds. We are taking our last $150 and investing in real estate investment trusts, or REITs. A REIT is a company that owns or finances property that produce income. We are talking about massive apartment buildings, shopping centers, office towers, or even the data centers that run the internet. When you buy a REIT, you essentially become a landlord, owning a tiny piece of a huge real estate portfolio without ever having to fix a leaky toilet. Why are we adding REITs? First, even more diversification. The real estate market often moves differently than the stock market. Second, they are designed to produce income. By law, REITs must pay out at least 90% of their taxable income to their shareholders in the form of dividends. And third, they give you access to an asset class that used to only be available to the very wealthy. The simplest way in is with a REIT ETF, which spreads your money across many different properties. This final $150 gives your portfolio exposure to a totally different part of the economy. I myself invested in VNQ ETF, which has over 160 different REITs. Another common one is O, which is a single company with more than 15,000 properties. Okay, let's wrap this up. That $1,000 that was just sitting there is now a smart 5-part investment machine. $100 in a high-yield savings account for immediate risk-free safety. $300 in a Roth IRA for powerful tax-free retirement growth. Another $300 in a standard brokerage account with ETFs as your flexible growth engine. $150 in a bond ETF that acts like a portfolio stabilizer. And the last $150 in a REIT ETF to diversify into real estate and generate income. We now have a plan that perfectly balances safety with growth and long-term goals with flexibility you can use sooner. This was never about a get-rich-quick scheme. It's about building a lifelong habit, a solid foundation, and the confidence to finally take control of your financial future. The hardest part of any journey is taking the first step. You officially have the map. Now go make it happen. If this guide gave you the clarity and confidence you were looking for, make sure to give it a thumbs up and subscribe to my channel. Thank you so much for watching, and I will see you in the next video.